What if the system doesn't collapse, but quietly changes the rules on you? Not with tanks, not with headlines screaming crisis, but with small policy shifts, higher borrowing costs, subtle currency moves, new regulations, and one day you wake up and realize the game you were playing for 15 years is no longer the same game. That is the real risk in the next phase of this cycle. If you want to understand where capital is moving before the crowd sees it, stay with me, because today we're going deeper. And if you value this kind of clear, structured thinking, make sure you like this video and subscribe to Think Like Dalio. This channel is built for long-term thinkers, not emotional traders. Now let's continue. In the first episode, we talked about the late stage of the long-term debt cycle. Today, we're focusing on something even more important: capital flows. Ray Dalio often says that money moves before headlines move. Capital is not emotional, it is strategic. It looks for safety, it looks for return, and when risk rises, it relocates. Right now, global capital is watching three things very closely: debt sustainability, interest rate policy, and geopolitical alignment. Let's start with debt sustainability. Governments across the world are carrying enormous debt loads. Servicing that debt becomes more expensive when interest rates rise. If a government must spend more on interest payments, it has less flexibility for everything else: infrastructure, defense, social programs, economic stimulus. When flexibility shrinks, policy options shrink. Investors understand this. Bond markets understand this. And when bond markets lose confidence, yields rise. Rising yields increase pressure. Pressure forces difficult decisions. This is how slow financial stress begins. Now let's talk about interest rates. For more than a decade, investors operated in a near-zero interest rate world. Cheap money boosted valuations. Growth stocks soared. Real estate expanded. Risk appetite increased. But higher rates change behavior. When safe bonds offer meaningful returns, investors reprice risk. When borrowing costs rise, leverage becomes dangerous. When liquidity tightens, speculation slows. This doesn't mean markets crash immediately. It means the margin for error becomes smaller. Dalio has explained that in late-cycle environments, policymakers face trade-offs. If inflation remains elevated, cutting rates too fast risks currency weakness and renewed price spikes. If they keep rates high, debt stress increases. This tension creates volatility, and volatility changes capital flows. Money may move from highly valued growth assets into defensive sectors. It may move from countries with fiscal stress into those with stronger balance sheets. It may move into real assets that hold value during inflationary periods. Now add geopolitics. We are in a period of shifting global alignment. Trade relationships are being restructured. Strategic industries are being protected. Supply chains are being localized. Financial sanctions have shown that reserves can be frozen. This changes how countries think about their assets. When trust declines, diversification increases. Some nations reduce dependence on a single reserve currency. Others accumulate gold. Some build alternative payment systems. These shifts happen gradually, then accelerate. Dalio studies these transitions carefully. In past world order shifts, capital did not disappear. It repositioned for individual investors. This matters more than predictions. If capital is repositioning globally, are you fully exposed to one market, one currency, one narrative? Radical transparency means looking at your exposure honestly. Are you assuming that one economy will outperform indefinitely? Are you assuming that inflation will return to extremely low levels permanently? Are you assuming that policymakers can always stabilize markets instantly? Those assumptions may work in early cycles. They become fragile in late ones. Let's make this personal. Imagine a scenario where inflation averages higher than expected for several years. Not hyperinflation, but persistent erosion. Your portfolio might show gains in nominal terms, but your purchasing power grows slowly. Or imagine a scenario where bond markets demand higher yields for holding government debt. This pressures valuations across asset classes. Markets don't collapse, they grind sideways. Volatile, frustrating. In that environment, patience becomes an advantage. Dalio often emphasizes balance, because balance allows survival across multiple outcomes: growth, inflation, deflation, stability, turbulence. The mistake most investors make is optimizing for one scenario. They build portfolios designed only for expansion, or only for low inflation, or only for a specific currency strength. But late-stage cycles are unpredictable in path, even if predictable in structure. Structure tells us debt is high. Structure tells us geopolitical competition is elevated. Structure tells us policy space is narrower than it was 15 years ago. Path tells us how events unfold, and that part is uncertain. So how do you respond intelligently? First, accept complexity. The world is not returning to a simple, synchronized growth model anytime soon. Second, focus on resilience. Assets that can survive multiple macro environments deserve attention. Third, reduce emotional reactions. News cycles amplify fear, but capital flows move on fundamentals, not headlines. Fourth, think globally. Opportunities and risks are no longer contained within borders. On Think Like Dalio, we focus on frameworks because frameworks outlast trends. One powerful framework is understanding that markets move between liquidity expansion and liquidity contraction. The last decade was dominated by expansion. The coming years may involve more contraction phases. In contraction phases, discipline matters more than optimism. Liquidity expansion rewards risk-taking. Liquidity contraction rewards selectivity. Another important idea is that systems rarely break at the point of maximum fear. They often break at the point of maximum complacency. Right now, ask yourself honestly, is the market environment built on caution or comfort? When valuations remain elevated despite rising structural pressures, that's a signal to think carefully. But remember, thinking carefully does not mean panic selling. It means adjusting expectations. Maybe returns are lower than the last decade. Maybe volatility is higher. Maybe diversification becomes more valuable. That shift alone can protect you. There is also a psychological transition happening. Younger investors have mostly experienced central bank support and rapid recoveries. Older investors remember stagflation, high rates, and prolonged drawdowns. Experience shapes expectations. Dalio's research shows that generational memory influences market behavior. When a generation forgets the pain of previous cycles, risk tolerance increases. That can push systems toward extremes. Radical transparency means studying those extremes before they reappear. And here's something important. Transitions are not only financial, they are social. When inequality widens, political responses intensify. Policy may become more interventionist. Tax structures may change. Regulation may increase. These shifts influence corporate profits and investor returns. Ignoring politics entirely is unrealistic. Overreacting emotionally is also dangerous. Balance requires awareness without panic. As we move deeper into this decade, the key theme is adjustment. Adjustment in expectations, adjustment in allocation, adjustment in mindset. The investors who struggle most are those who refuse to adjust because the old strategy worked before. The investors who thrive are those who accept that cycles evolve. Dalio built his success not by predicting every event, but by preparing for a range of possibilities. He stress-tested portfolios. He asked what happens if inflation rises, what happens if growth slows, what happens if currencies weaken. You can apply the same thinking at any scale, even if your portfolio is modest. The principle holds: spread risk thoughtfully, avoid excessive leverage, maintain flexibility, because when capital flows shift, they shift quickly. Before we close, I want you to think about your current positioning. If the next 5 years include higher volatility and moderate inflation, are you prepared? If global alignment shifts further and currency competition increases, are you diversified enough? If markets deliver lower average returns than the past decade, can your plan still work? Write your thoughts in the comments. I read them. This community grows stronger when we share ideas and perspectives. And if this episode helped you see capital flows differently, share it with someone who is still thinking in old cycle terms. Subscribe to Think Like Dalio if you haven't already. In the next episode, we'll break down specific asset classes and how they behave in late-stage debt environments. The rules are not ending. They are evolving, and those who evolve with them protect and grow their capital in ways others don't even see coming.